Stop. Before you click away, answer one question honestly. If the world shakes again tonight, what do you want holding the weight of your savings? Because right now, the headlines are screaming gold 5,000, while the charts are whispering something even crazier. Silver $100. Gold is hitting records. Silver is making history. And if you only have room for one safe haven in your portfolio, you can't decide with vibes. You decide with math, mechanics, and one brutal truth about how crises actually work. Welcome back. Today we're settling the fight. Gold at 5,000 versus silver at 100. Which one is the real safe haven right now? Let's set the stage. We're in the kind of volatility where markets move like they're stepping on ice. Stocks gap, bonds wobble, currencies feel like they're being repriced in real time. And in that environment, safe haven doesn't mean never goes down. Safe haven means when trust breaks, you own something that doesn't depend on someone else keeping a promise. That's the core test, counterparty risk. Can your asset survive a confidence event? Gold passes that test, silver passes that test, but they do it differently. Why gold feels like a fortress gold is the grandfather safe haven. It's the metal central bank's hoard. Not because it's shiny, but because it's neutral. No issuer, no default, no earnings call, no CEO scandal. It's an asset that exists outside the financial system. Gold is also calmer. If you've ever watched a panic day, you know this. Gold can dip, but it usually doesn't behave like a roller coaster. It's designed, by history, to be the adult in the room. So why is gold near $5,000? Two forces. First, the long, slow leak in fiat trust. When deficits look permanent and policy looks reactive, people buy what can't be printed. Second, the pivot. When the Federal Reserve starts leaning toward rate cuts, the entire menu changes. Higher rates punish non-yielding assets. Lower rates remove that punishment. So when the Fed signals cuts, it's like taking the ankle weights off gold. That's why people call it rocket fuel for metals. Not because cuts magically create value, because they change the competition. Cash yields less. Bonds yield less. The hurdle rate drops, and gold, quiet, heavy, patient, looks smarter by the minute. Gold's safe haven strengths are simple. Deep global liquidity, central bank demand as a backstop, lower volatility than silver, strong crisis branding in the public mind. But now we have to talk about the elephant in the room. Gold at $5,000 is not cheap. It can still go higher, but your upside is mostly a trust story. Gold's demand is primarily monetary and psychological. That's powerful, but it's not the same as physical necessity, which brings us to silver. Why silver is moving like a wildfire. Silver at $100 isn't just a price, it's a signal. It says the market is reclassifying silver from small precious metal to strategic material. And here's the first piece of math you need to see. Gold at $5,000 and silver at $100 implies a gold to silver ratio of 50 to 1. 50 ounces of silver to buy 1 ounce of gold. Now the ratio is not a law of physics, but it is a thermometer for value perception. Historically, in calm times, the ratio can drift high, 60, 70, even 90. In stress times, especially when silver is catching up, the ratio compresses. In other words, silver tends to outperform late in a metals cycle. Why? Because silver is the weird hybrid. It's money, and it's an ingredient. Gold is a store of value. Silver is a store of value that also gets consumed. That second part is the kicker. When silver demand rises, you don't just get investors. You get buyers who can't wait for a dip because their product pipeline depends on it. Think solar, electronics, high-end manufacturing, medical components, power systems. Those buyers don't care about your chart pattern. They care about delivery. So when silver starts to run, it often runs harder. And that matches what you're seeing. Gold is up, but silver is outperforming in percentage terms, roughly 40% in just 3 weeks in this scenario. That is classic silver behavior. Higher volatility, higher beta, bigger moves. But volatility is the price of admission. A real safe haven must answer two questions. Can it protect me in a confidence break? Can I live with its drawdowns on the way? Gold usually answers yes to both for most people. Silver answers yes to the first and depends on your stomach to the second. The ratio decision. Is silver still cheap at $100? Let's do a thought experiment. If gold stays at $5,000 and the ratio compresses from 50.1 to 40.1, silver would be $125. If it compresses to 30.1, silver would be about $166. If it compresses to 25.1, silver would be $200. That's not a prediction. That's just arithmetic. The ratio is the lens. Now flip it. If silver holds $100 and gold mean reverts down a bit, the ratio expands and silver could chop sideways while gold steadies. So the ratio tells you the tension. At 51, silver is not screaming expensive relative to gold. It's saying silver has already moved, but the catch-up trade is not finished if the cycle continues. But the ratio alone is not enough, because you're not buying a spreadsheet. You're buying an asset with real-world friction. The hidden costs: friction, premiums, and liquidity. Gold is easier. Smaller bars, smaller coins, higher value per gram. Storage is simpler. Transaction spreads are often tighter. Silver is bulk. A meaningful amount of wealth in silver is heavy, large, and sometimes awkward. And in stress moments, premiums can explode, meaning the price you pay for physical silver can diverge from the screen price. That's the safe haven paradox. When you want the metal most, the market charges you the most to get it. So here's a practical rule. If your goal is wealth insurance, protection, not excitement, gold is usually the cleanest tool. If your goal is wealth insurance plus upside, meaning you want protection and you want the metal with the potential to sprint, silver becomes attractive, but only if you manage position size and volatility. The two safe haven traps. Nobody warns you about. Trap 1. The everything sells moment. In a real panic, the first wave is not logic, it's margin calls. Funds get hit, brokers call, and traders sell what they can sell, fast. That includes gold. That includes silver. That includes anything liquid. This is why people get confused and say, wait, gold fell during the crash. Yes, sometimes it does, briefly. Not because it failed, but because it was used as a fire extinguisher to cover losses elsewhere. Here's how the movie usually plays out. Phase A. Shock, stocks drop, volatility spikes, and the first instinct is raise cash. Metals can dip in this phase. Phase B. Response. Central banks step in, governments announce support, and real yields start falling. This is where gold and silver typically turn. Phase C, aftermath, trust damage sets in. People realize the rescue isn't free. That's when store of value becomes the main story. Gold shines in Phase B and Phase C. Silver can get punched in Phase A, but when it turns, it often turns like a slingshot. Trap 2, the safe on paper, not in your hands. Problem. A lot of people think they own metal, but what they really own is a claim on metal. There's nothing inherently wrong with paper exposure. ETFs and accounts can be efficient, but understand the difference in the promise you're buying. Physical. You own the thing, no permission required. Paper. You own a contract, and the system has to function for the contract to behave perfectly. In normal times, paper tracks well. In abnormal times, the details start to matter. Settlement rules, redemption limits, fund structure, broker policies, delivery timing. That's why you'll hear hardcore metal people repeat one annoying sentence. In a true crisis, access matters more than price. So when you ask real safe haven, clarify what you mean. Price safe haven or access safe haven? Gold tends to be better for price stability. Silver can be better for scarcity upside, but physical ownership, especially of a sensible amount, can be better for access insurance. Now, before you go full doomsday, keep this grounded. You don't need a bunker. You need a plan. The retail reality check, what you can actually do. Let's make this practical. Step 1. Decide your mission. Are you hedging inflation, currency debasement, market crash risk, or all of it? If it's primarily, I want my purchasing power to survive, gold is the cleaner core. If it's, I want protection plus growth, silver earns a seat. Step 2. Decide your vehicle. For most people, there are 3 common ways: physical bullion, coins, bars, metal-backed funds, miners, which are not the same as metal. Miners can explode upward, but they also carry company risk, jurisdiction risk, and equity market risk. So if your word is safe haven, miners are the spice, not the base. Physical is the purest safe haven expression, but it has friction, storage, insurance, spreads, premiums. Funds are convenient, but they rely on plumbing. Choose based on your mission, not on someone's hype tweet. Step 3. Decide your behavior rule. This is the real difference between winners and regret. Gold is forgiving. You can buy, hold, forget. Silver is not forgiving. Silver demands discipline. It will test you with pullbacks, fake-outs, and face-melting candles. So you set a rule like, I buy in tranches. I do not use leverage. I don't chase a vertical day. I keep dry powder for dips, because the fastest way to lose the safe haven is to turn it into a casino chip. The simple safe haven scorecard. Let's grade them fast. Stability, gold wins. Volatility, upside torque. Silver wins. Portability, value density. Gold wins. Affordability for small buyers. Silver wins. Industrial necessity. Silver wins. Central bank backstop. Gold wins. And here's the sneaky one, psychology. In a crisis, the crowd runs to gold first. Then, If the move continues and the ratio compresses, the crowd discovers silver. That second wave is why silver can go ballistic late. So when you see silver outperforming early, pay attention. It can mean the cycle is accelerating or the supply tension is real, or both. All right, with that foundation, now we can talk about the Fed pivot, because it's not just a tailwind. It's a filter that decides which metal leads. A quick example with real numbers. Say you're a retail investor with $10,000 you want to crisis-proof. If you put it all in gold at $5,000 Oz, you're basically buying exposure to 2 ounces of gold through whatever vehicle you use. Clean, compact. If you put it all in silver at $100 Oz, you're buying about 100 ounces. That sounds simple until you remember 100 ounces is bulky in physical form, and premiums talk spreads can matter more. So here's the trick. Compare outcomes after friction. If your silver premium is, say, 8% and your gold premium is 3%, your break-even math changes. Silver still might win on upside, but you need a bigger move to outrun the higher friction. This is why pros often split it. Gold as the compact core insurance, silver as the higher volatility satellite. That structure lets you benefit from silver's sprint without letting its swings wreck your sleep. One more practical note. Don't confuse a safe haven with a timing trade. If your plan is, I'll buy and sell next week, you're not doing protection. You're gambling. Safe haven positioning is about months and years and about ownership you can hold through noise. Now let's zoom back out to the macro engine driving both metals. Boring beats brilliant here. The best safe haven plan is the one you can execute when you're scared, tired, and the chart is screaming at you. The Fed pivot. Why cuts push both, but change the winner? When rates fall, both gold and silver benefit because they don't pay interest. Lower yields make holding nothing less painful. But silver has a second engine, growth narratives. If the Fed is cutting because growth is slowing, you might think industrial demand drops and silver suffers. But if the cuts are part of a broader liquidity wave, more money chasing fewer real things, silver can still surge because it's both a monetary escape hatch and an industrial bottleneck. So the Fed pivot acts like a tide. Gold rises with the tide, silver rises with the tide, and can also surf the wave. That's why in late cycle moments, silver can feel like a safe haven with a turbocharger. Which one is the real safe haven? Here's the answer, and it's not sexy. Gold is the better sleep at night safe haven. Silver is the better protect and potentially multiply safe haven. So ask yourself what problem you're solving. If your fear is currency debasement, policy disorder, or a confidence break, and you want the smoothest ride, gold wins. If your fear is the same, but you also want exposure to an asset that can outperform violently when the ratio compresses, silver wins. But there's a third option that almost everyone ignores because it's too reasonable, a barbell. Gold for stability, silver for convexity. Example framework for retail investors. 70% gold, 30% silver if you want insurance with a kicker. 50-50 if you can tolerate volatility and you want performance. 30% gold, 70% silver if you're positioning for a ratio crash and you can handle drawdowns. No, that's not financial advice. That's a decision map. The one metal only test. If you force me to pick one metal for the average person watching this video, here's how I decide. Pick gold if you're protecting retirement savings, you hate volatility, you want liquidity everywhere, you want the asset central banks already endorse. Pick silver if you're younger or more aggressive, you can hold through violent swings, you believe the ratio compresses further, you think industrial demand makes silver structurally scarce. And here's the sentence that matters most. Gold is the shield. Silver is the shield with a blade. Final, the math. You need to remember gold $5,000, silver $100. Ratio 50.1. If the ratio compresses, silver's upside is mechanically larger. If the world freezes, gold is the calmer store of value. If liquidity floods, silver can sprint. So don't ask, which is better? Ask, which risk am I willing to hold? Because in the end, safe haven isn't about being right. It's about still standing when the room goes dark. If you want, comment one word. Gold if you want stability. Silver if you want the turbo. And if you're building the barbell, comment both. And I'll pin the best allocation frameworks in the next update.